I'm taking in, Melissa, everything that's been said by people who tried to explain this market sell-off and that has later been incorporated by the Fed, okay? And other than the Fed itself, there's 4 big reasons people have mentioned with a new one on top. You got the government shutdown, you got the trade tensions, you got the global weakness, and you have the market volatility itself, which creates its own weaker environment down the road. I can cross off one of those, and maybe I cross off the biggest one, which may be the trade tension ones. I still got 3 things I'm worried about in 3 areas of uncertainty. And I want to...
Why isn't volatility?
Although volatility compressed dramatically. We hit 17s today.
I put market volatility in there because I didn't want to put tighter financial conditions, which is the way the Fed actually looks at it. My mistake. I should have been more accurate. What the Fed sees is the lower rate of the market, and it sees the concern in the market, says, you know what, financial conditions may have tightened more than we wanted them to. So all of that leads me to what I think are new rules for the Fed.
Well, there's 2 things you left off. First of all, oil. Back up to 53.5. We discussed that the Federal Reserve is looking at a $40 oil price. And then the second thing is the high yield market. For 6 weeks, you didn't have an offering in the high yield market. The Federal Reserve picked up on that.
So I would jump in there and I would just say I agree on the oil, but if you look at inflation expectations, which is something that the Fed watches in terms of tips break-evens or even just consumer expectations for inflation, those do remain quite low still. We're back around 1.8% for a 10-year tips break-even. So getting back toward their 2%, I think, would put them a little bit more comfortable toward that.
Yeah, Joe, I'm not sure low oil prices is something the Fed would say is a concern for it. It may be a concern for the market, but how the Fed, it's something we've talked about on this show, whether or not low oil prices these days are good or bad. But I do want to talk about new rules for the Fed, which lead me to say that just the elimination of trade tensions does not bring the Fed back in. I think they are in a completely different regime now. No preemptive tightening. They're waiting for headwinds to clear.
So Mr. Powell really learned in the past few months or so to take his cues much more from the markets and to maybe be more cautious about
I think he learned a lesson of bringing the market along with it, which is the way that, you know, let's go back. You know,
or patience, which is what he cites over and over again.
Yeah.
Each member of the Fed has used that word. Yeah, patience. Each one of them, Steve, as you know, they go out with a specific phrase or in some cases a word, and that's the word right now, it seems. Patience.
Many years
so that people understand that it's
many years
slow.
ago, I asked a friend of the family if they had bought a house in this summer vacation area. And the woman said, I have not convinced Nate that that's what he wants to do yet. and this is a bit the way
I understand that
the Fed needs to treat the market. The Fed has not convinced the market that raising rates is the thing that it wants it to do.
Right.
Well, and this is one of the new rules here.
Well, the Fed, the presence of rising wages alone should never be the trigger for the Fed to be preemptive tightening. The last 2 economic cycles did not end because of cost pressures. It's just not what happened. We blew up 2 bubbles. That had nothing to do with rising wages. In fact, wages were stagnant in 2000, 2001 when they should have been growing faster. Wages were very stagnant in the 05, 06. So the Fed in neither case was trying to head off wage growth inflation. And this time, it's much the same. We do not have a problem with people not having the money to pay their employees more. In fact, half the states in the country starting this year have done their own unilateral minimum wage hikes, not even waiting for the federal wage hike to come.
Although
so
states
I don't
have
think
raised their minimum wages as well.
But that's my point. Half the states plus DC. So if we're saying,
can I go back to my screen here, Josh? Because that was on the screen.
All right. Well, I'm doing it for you because I'm going to give you.
I did in about 3 words. Can you take a
I'm going to give it to you from my perspective.
Go ahead, Josh.
Press 200.
We got all the time we want. Look at that. See that?
Actually, we don't.
See that? Seek neutral and coast. That's what I'm saying here, Josh.
All right, the idea
very
elegant.
They don't know where it is. Seek, what is that? 4 words? Go ahead, Josh. You keep going.
No. I don't want to keep going. I want to move forward. Can we move forward?
Catch me after the show on YouTube. I'll give you the rest.
Yeah, we'll give it a 40-minute day.
Minus 15 minutes. But the reason why I asked you, Steve, is let's say the trade war goes away.
Yeah.
What impact will that have on economic growth? And will the market specifically be back in that box where growth is stronger and we're all worried about rising rates again?
Yeah, so what I didn't do, what I was going to do was take that list of the 4 risks out there, and I was going to pencil in what economists say are the general decline from GDP to those things, right? But the way this has ended up working is you take out your shovel and you dig a hole that's 2 feet. And then you take out your shovel and you dig a hole that's 2 feet more, and all of a sudden you're down 6 feet. You're 6 feet under. These things have accumulated one on top of another, such that I don't know what it's going to take. I thought it was interesting that Steve said he's worried about more things than just all these things that are out there. And he's sort of taken all these things on top. I think that what's happened is these guys said the trade tensions were going to be 0.1. But there was also an uncertainty factor.
Yeah.
Now you got the government shutdown, which could lop off.
So the multiplier in the other direction could also be greater.
Right, the
and
X factor.
the point is that the Fed does not operate in a vacuum, right? So if we do get a better growth environment, we're hesitant to totally write off the Fed in 2019 if we do get that 2 to 2.5% growth that we're expecting.
And I think the Fed's now.
Okay, that's the real last word.
This will be the last.
I think that's important.
I think the Fed is now conditioned. Their behavior is conditioned a little bit. So they will be a lagging indicator to a rising economy. So the market will have time to worry about it because the economy will be going up.